Right, commodities have been a pretty good place to be for the last 6 months. The sector has outperformed the broader market as more confidence is coming into the sector. So certainly some of the selective tailwinds we saw last year are broadening, I think, into more general and sector specific tailwinds rather than commodity specific. So firstly, please acknowledge the disclaimer. This is all general advice, is what I'm discussing today. And starting with where I think you should start when looking at the commodity sector, and that is your commodity allocation. So since we had a chat to Share Cafe in February, things haven't moved all that much. Our key exposures remain copper, uranium, domestic gas, although our gold exposures have increased a little bit. I'd probably like to flag our rare earth exposure is increased a bit as well. We added some more rare earth exposure last week on tentative signs of a rebound in prices, which certainly seems to have started to get a bit of traction more broadly in the market. But just diving into a couple of the commodities, we'll start with copper. So the drivers behind copper, are reasonably well established, but perhaps the extent to which copper demand has transferred from historical drivers of demand through to the new sort of future-facing drivers of demand is not as well understood. So on the chart on the right-hand side here, we have copper demand coming from China construction and the energy transition. And you can see from around about 2022, Chinese energy transition demand surpassed construction demand as the key driver of copper demand. And so that means that despite the Chinese construction sector being a little bit sluggish and the Chinese economy being a little bit slow overall, copper demand is still growing quite strongly, driven by that energy transition demand, and that's leading to divergent performance of commodity prices. And you can see that in the bottom left with copper price outperforming iron ore quite strongly so far in calendar 24, and we think that's likely to continue. But if this is the broad brush sort of general drivers of demand, there have been a few questions on the more sort of shorter term drivers, and specifically I'm talking about inventories. So despite copper doing very well calendar year to date, inventories in China haven't started drawing yet this calendar year. And that has caused some people to sort of push back on the bullish thesis. I would counter that by saying that there is multiple areas of copper inventory throughout the supply chain. So it's not just in the refined metal, it also exists in semi-finished products. It also exists in copper concentrate as well. And that's what that chart on the right-hand side is showing. Copper concentrate stocks are drawn down to levels that haven't been seen in the last 5 years, even though refined metal inventories are at sort of seasonal highs. So the point here is that I think the copper price is moving in anticipation of a refined metal shortage, even though it hasn't yet shown up in refined metal inventory movements. Moving on from copper into energy, and I think this has become particularly topical now that in the wake of the budget, the natural gas or the energy situation on the east coast of Australia remains dire, and I must admit the west coast is not that much different. This is the gas supplies out of Longford, which supplies 70% of east coast gas demand. And about a month ago, this chart on the right-hand side was released, which has a projection of Longford supply throughout the rest of its life. And this really put the cat amongst the pigeons because the y-axes here are the same on both charts. So you can see over the last 4 or 5 years, we've needed about 1,000 terajoules of supply out of this field to meet demand through the winter months. Right here, you can see there's a maximum capacity now of 700 terajoules, and that's falling away quite quickly. So we are going to have gas shortages on the East Coast. The only way for that to be addressed is going to be by LNG imports. They are going to be higher cost, and that is flowing through into gas pricing now. So contracts are being written at $15, $16, and if we have one of the the old rickety coal-fired power stations trip up at some point through winter, then I think we can have a spike back to $20, $30 a gigajoule, similar to what we had in 2022. So, this is a thematic that is playing out as we expected. It did take a little bit longer, but, we are at the crunch point here. And I suspect with the government, acknowledging the role that gas is going to play from now until 2050 and beyond, that provides a much better background for M&A to start to take place in this sector. And also, I believe that's going to flow into power prices as well. So, everybody should hold on to their $300 that they've found out they're getting in the budget earlier this week, because as gas price goes, the power price will follow. So this is the gas price in red. You can see it correlates quite strongly with power prices on the East Coast. As that gas price ticks up, you are going to see a tick up in power prices, and I think that's going to end up being a second wave of inflation to worry about in 2025. So again, it's not particularly good news, but still it is what it is, and I think this is absolutely inevitable. Something that has been going up almost as fast as gas prices is gold, and there's so many stocks out there that it would be remiss of me not to touch on this commodity briefly. Over the last probably 2 months or so, we've had this big transition in expectations of rate cuts. So, rewinding to sort of late December, the market expected a huge, I think it was 4 or 5 rate cuts over the course of calendar 24. Those expectations have reversed to sit more or less in line with where the Fed was guiding to via their dot plots. But I think what's changed now is the risk of it to where expectations are going to go. And what's driving that, my view there is some of these charts on the US consumer are starting to suggest to some wobbles to the resilient strength of that consumer and driver of the US economy. So things like expectations of real income have plummeted. Google searches for claim benefits have started to increase, which has been a pretty reasonable lead indicator of jobless claims. So that means that expectations for rate cuts, I think, will start to increase again. And so the market pricing for the Fed funds rates should start to roll over. And that is prima facie quite bullish for gold. And certainly gold got a little bit of a boost by the lower than expected inflation numbers out of the US last night. So, there's some broad brush views on a couple of different commodities. But from now, I will step into a couple of stocks, which I think may be of interest. Firstly, bauxite is not a commodity that we hear a lot about in the on the ASX. There's not very many exposures, but this is a large bulk commodity. We're all very familiar with iron ore, and bauxite seems to be at the beginning of its iron ore moment. Domestic supplies of bauxite are running out in China. They're importing more and more from Guinea in West Africa. But Metro Mining's deposit up in Cape York in sort of northern Queensland has a structural cost advantage, versus those cargoes from West Africa. And on top of that, they're also starting to enjoy some substantial cost savings from their economies of scale. So Metro's guiding to about 7 million tonnes of production for calendar 24 at a margin of around about $15 a tonne, but that's based on DFS pricing. Since they did that DFS, pricing has continued to increase. So I think there's probably a bit of upside risk to that margin number, but you multiply that through production, and you end up with an EBITDA estimate of around about $100 million, and that compares with an enterprise value of around about $270 million. So again, this stock looks, it does look interesting and quite cheap, and if they can deliver on their guidance, then this stock should, I think, do quite well. And you can see they're off to a reasonable start in calendar 24, sitting well above their calendar 23 run rate already. But from bauxite, we're going to switch on to silver, and this is not not a commodity that you have a great deal of options to choose from on the ASX, but just recently, Mitre Mining has raised a little bit of money and started to get some attention. These guys have pegged a very high grade silver gold system over in Chile. You can see some of the grades from rock chips on the slide in front of you, which I've pulled out of one of their presentations. But what caught my eye with this company was the incumbent infrastructure. So, these guys have a ball mill already on site. It's fully permitted. They have access to power. They have access to water. They've got access to infrastructure. It was a producing mine as recently as 2022. But these guys got a hold of this asset for a song, and the potential to expand this resource, which already sits at 50 million ounces of silver equivalent, is substantial. So, but as I've said in quite a few of my presentations, we don't pay for exploration upside. This company's got an EV of around about 60 or 70 million dollars. Well below the value of the infrastructure on site. But we think that if they can, there is some obvious low-hanging fruit here to hit with a drill rig, and over time this should grow into a sizable silver resource, and certainly has a decent tailwind behind it by way of the silver price. So, in short, there's the way that we're looking at commodities. There are a couple of stocks which I think are interesting. We do swing between our commodities through active management in a very dynamic way. I mean, we've done well out of gold and lithium in cycles past. Last year was all about uranium. I think going forward in calendar 24, domestic gas, copper, and the precious metals are all looking good. And hopefully we should still see that average performance since inception of 30.5% net of all fees continue to increase. So with that, I'll flick on to my last slide and hand it back to you, Manny. Thanks very much.